You are 32 years old when you first enter Wall Street at a level that actually matters. Before that, you believed markets were driven by intelligence, research, and economic reality. The public version of Wall Street teaches that prices move because information changes. What you quickly discover is that information is only one layer of a much larger system. The real game is access, speed, capital, and influence. Your first position gives you control over only a few $100 million. To most people, that sounds enormous. On Wall Street, it makes you almost irrelevant. Every morning you sit in meetings where billions of dollars are discussed as casually as someone discussing groceries. A single trading decision can move more money in 1 hour than most people will earn in thousands of lifetimes. At first, this feels exciting. You believe that if you make enough correct decisions, you can control outcomes. The system rewards you immediately. Your compensation rises faster than anything you have experienced before. Your annual income becomes larger than the value of entire neighborhoods where you grew up. Expensive apartments, private clubs, exclusive conferences, and direct access to powerful people become normal. The transition happens so gradually that you barely notice it. The illusion begins here. You think you are entering a market. In reality, you are entering a hierarchy. Every participant depends on someone larger. Analysts depend on portfolio managers. Portfolio managers depend on capital allocators. Capital allocators depend on institutional investors. Institutional investors depend on pension funds, governments, and central banks. The deeper you look, the more you realize that Wall Street is not a collection of independent investors. It is a network of interconnected incentives. Within 2 years, your performance exceeds expectations. Assets under your supervision increase from hundreds of millions to several $1 billion. People begin returning your calls immediately. Financial media asks for interviews. Companies want meetings before making major decisions. For the first time, you feel something dangerous. You begin to believe that the system is responding to your choices. You begin to believe that you are gaining control. You are wrong. You have only reached the entrance. By the time you manage several $1 billion, you finally begin to understand how Wall Street actually functions. The public sees stock charts, earnings reports, and financial news. The system itself operates very differently. Every day begins with one objective: attract capital, protect capital, and grow capital. Everything else is secondary. Your fund earns money through management fees and performance fees. The larger your assets become, the more stable your income becomes, regardless of whether your investors outperform the market. This creates a hidden incentive structure. Officially, everyone talks about returns. Internally, growth in assets often matters just as much. A fund managing $2 billion and earning 15% may generate less revenue for its managers than a fund managing $20 billion and earning 8%. You also discover that information is not distributed equally. Large institutions receive direct access to executives, industry experts, analysts, and government officials. None of this is necessarily illegal. It is simply a consequence of size. The larger your influence becomes, the more information flows toward you. Smaller investors react to news. Large investors often position themselves before the news becomes important. The system is built on leverage. Banks lend money. Funds borrow money. Corporations issue debt. Governments issue debt. Pension funds buy debt. Nearly every major institution depends on debt to increase returns. This creates a chain of dependency where stability depends on confidence. As long as participants believe the system works, liquidity remains abundant. When confidence disappears, the entire structure can tighten within days. Your daily decisions now influence thousands of employees, millions of retirement accounts, and billions of dollars in capital. At first, this responsibility feels empowering. You believe larger numbers mean greater control. But the opposite is beginning to happen. Every new investor brings expectations. Every quarter creates performance pressure. Every public appearance creates reputational risk. The higher you climb, the less freedom you actually have. Investors expect growth. Banks expect activity. Analysts expect guidance. Media expects certainty. You begin to realize that Wall Street does not reward independence. It rewards participation in a system that must continuously expand to justify its own existence. And now you are no longer observing that system. You are becoming part of it. The first major change is not financial. It is behavioral. Once you understand how Wall Street operates, you stop thinking in terms of months and begin thinking in terms of quarters, years, and capital flows. Every conversation becomes a calculation. Every opportunity is measured against risk, expected return, and potential downside. Gradually, your personal life begins to adopt the same structure. Your assets under management continue growing. 5 billion becomes 10, 10 becomes 20. Each increase gives you access to larger deals, better information, and more influential networks. CEOs who once ignored your emails now request meetings. Investment banks offer private briefings before major transactions. Hedge fund managers who were previously competitors become potential partners. The system rewards scale because scale creates influence. Your lifestyle improves dramatically, but not in the way most people imagine. The luxury itself becomes unremarkable. Private flights, exclusive memberships, and expensive properties quickly become routine expenses. The real advantage is efficiency. You can access people faster. You can solve problems faster. You can move capital faster. Time becomes your most valuable asset. At the same time, your decision-making process evolves. You stop searching for individual winning stocks. Instead, you focus on sectors, liquidity flows, interest rate expectations, and institutional positioning. A company is no longer a product or a brand. It becomes a collection of numbers, cash flows, and probabilities. You begin viewing entire industries as pieces of a larger machine. The adaptation works, performance improves, investors are satisfied. Financial media starts treating your opinions as signals. A single comment during an interview can move millions of dollars within hours. At first, this surprises you. Later, it becomes normal. That normalization is important. Human beings adapt quickly to power. What felt extraordinary 2 years ago now feels expected. The larger your influence becomes, the more you assume it will continue growing. You begin making plans based on future success rather than current reality. This is where the system becomes dangerous. Success creates confidence. Confidence improves decision-making up to a point. Beyond that point, confidence starts replacing caution. You are approaching that point now, and Wall Street has a long history of rewarding confidence right before it punishes it. At $25 billion under management, your role changes again. You no longer spend most of your time searching for opportunities. Instead, you spend your time protecting a structure that has become too large to move easily. Every position is bigger. Every decision affects more people. Every mistake becomes more expensive. The dependency develops slowly. At first, investors depend on you. Pension funds allocate capital because they trust your performance. Wealthy families invest because they trust your judgment. Institutions use your reports to guide decisions, but over time the relationship becomes mutual. You begin depending on them just as much as they depend on you. A significant percentage of your revenue now comes from maintaining investor confidence. If major clients withdraw capital, assets shrink. If assets shrink, influence shrinks. If influence shrinks, access to opportunities becomes weaker. The machine only works efficiently when it keeps growing. You start noticing that many decisions are no longer based purely on expected returns. Some decisions are made to maintain appearances. Investors expect confidence during uncertainty. Markets expect optimism during volatility. Media expects certainty even when nobody actually knows what will happen next. The system rewards the people who appear confident, regardless of whether that confidence is justified. Meanwhile, leverage across the financial system continues increasing. Corporations borrow heavily because debt remains cheap. Funds borrow because leverage improves returns. Banks expand lending because demand remains strong. The entire market becomes increasingly dependent on conditions remaining favorable. Everyone understands the risk, but nobody wants to be the first person to step away while profits are still growing. Your daily routine reflects this dependency. Every morning begins with market updates. Every afternoon is filled with investor calls. Every evening involves risk reviews and strategy meetings. Even when you're not working, your attention remains connected to markets operating somewhere in the world. The most dangerous part is that none of this feels unusual anymore. The system has become normal. You have adapted to it completely. And when dependency becomes normal, people stop asking whether the system can fail. They only ask how much bigger it can become. The pressure does not arrive as a crisis. It arrives as a series of small changes that gradually alter the behavior of everyone around you. Interest rates begin moving higher, borrowing becomes more expensive, economic growth slows, investors who once demanded aggressive expansion suddenly begin asking questions about risk. For years, rising markets solved most problems. If a company missed expectations, investors looked forward to the next quarter. If a fund underperformed temporarily, strong market conditions often hid the weakness. Now those conditions are changing. The first warning signs appear in places most people ignore. Trading volumes become less predictable. Corporate earnings stop growing at previous rates. Debt refinancing becomes harder. Some companies that depended on cheap financing start reporting problems. Individually, none of these developments seem dangerous. Together, they begin creating friction throughout the system. Your investors become more demanding. Quarterly meetings that once focused on growth now focus on protection. Instead of asking how much money they can make, clients ask how much they can lose. The tone changes, expectations change, trust becomes conditional. Inside your organization, the pressure spreads. Analysts bring more negative reports. Risk managers recommend reducing exposure. Portfolio managers disagree about strategy. Every decision now has visible consequences. If you remain aggressive and markets decline, losses will be severe. If you become defensive and markets recover, investors may leave for competitors. The media contributes to the pressure. Every public statement is analyzed. Every prediction becomes a headline. Financial television wants certainty during a period when certainty does not exist. The more influential you become, the less room you have to admit uncertainty. At the same time, competitors face the same environment. Nobody wants to be the first institution to retreat. If everyone remains aggressive, staying defensive can damage performance. This creates a collective incentive to continue taking risks, even when those risks are becoming increasingly obvious. For the first time in your career, you begin understanding a reality that most people never see. Wall Street does not fail because nobody recognizes danger. Wall Street often fails because everyone recognizes the danger at the same time and hopes someone else will react first. And under that pressure, even intelligent people start making decisions they would normally avoid. The mistake does not happen in a single day. Looking back, you will realize it was actually dozens of smaller decisions that gradually pushed you toward the same outcome. The problem is that years of success have changed how you interpret risk. For nearly a decade, your assumptions have been rewarded. When markets declined, they recovered. When volatility increased, opportunities appeared. When competitors became cautious, aggressive positioning often produced better results. Experience has taught you that confidence pays. Unfortunately, experience can become dangerous when conditions change. Your team presents multiple warnings. Debt levels across several sectors have reached historical extremes. Corporate defaults are increasing. Liquidity in certain markets is becoming thinner. Some analysts recommend reducing exposure and raising cash reserves. The data does not suggest immediate collapse, but it clearly suggests increasing vulnerability. You listen to the reports, you understand the risks, then you make the decision that seems reasonable at the time, you stay invested. The logic appears sound. Exiting too early could cost billions in missed gains. Investors expect performance. Competitors remain aggressive. Economic data remains mixed rather than catastrophic. From your perspective, the probability of continued growth still appears higher than the probability of a major breakdown. The problem is that probability and consequence are not the same thing. Even if the chance of a severe market disruption is only 20%, the potential damage is large enough to matter. But after years of success, your focus has shifted toward maximizing returns rather than minimizing catastrophic outcomes. You increase positions in sectors that have performed well historically. You allow leverage levels to remain elevated. You approve several large investments that depend on stable credit conditions. None of these decisions seem reckless individually. Together, they create a portfolio that is far more exposed than you realize. The market continues rising for several months. Your confidence grows. Investors praise your conviction. Financial media highlights your performance. The decision appears correct. That is exactly what makes it dangerous. Because the market has not yet tested your assumptions, and when that test finally arrives, it will expose risks that have been accumulating quietly beneath the surface for years. The first cracks appear exactly where the system is supposed to be strongest. Large institutions begin reporting unexpected losses. A few highly leveraged funds are forced to sell assets to meet margin requirements. Credit markets become less liquid. Transactions that normally take hours now take days. The changes are subtle enough that the general public barely notices them, but inside Wall Street the mood shifts immediately. You start receiving calls earlier in the morning and later at night. Risk teams demand updated reports. Banks ask for additional collateral on positions that were considered safe only months ago. Investors request emergency meetings. Everyone is still speaking calmly, but the questions have changed. Nobody is asking about growth anymore. Everyone is asking about survival. Your portfolio begins experiencing pressure from multiple directions simultaneously. Companies that depend on borrowing face refinancing problems. Asset prices become more volatile. Correlations that were supposed to provide diversification stop working. Positions that were designed to offset risk begin losing value at the same time. The instability spreads through the system because the system itself is interconnected. One fund sells assets to raise cash. Those sales push prices lower. Lower prices force another fund to sell. That selling creates additional losses elsewhere. Nobody intends to create panic, yet the structure naturally amplifies stress once it begins. For the first time in years, you stop focusing on returns entirely. Every meeting becomes a discussion about liquidity, how much cash is available, which positions can be exited quickly, which assets might become impossible to sell during a crisis. Questions that seemed theoretical 6 months ago now dominate every decision. The market is still functioning, but confidence is weakening, and confidence is the foundation upon which the entire financial system rests. Banks trust counterparties because they believe obligations will be honored. Investors provide capital because they believe markets will remain liquid. The moment those assumptions weaken, instability accelerates. You begin realizing something uncomfortable. The system that made you powerful is the same system limiting your options. The larger your positions are, the harder they become to exit. The more influence you have, the more people expect answers you cannot honestly provide. The instability is no longer happening somewhere else. It is happening inside your own balance sheet. The realization arrives during a meeting that should have been routine. Your team presents updated numbers, liquidity forecasts, and exposure reports. On the surface, everything still appears manageable. The fund remains operational. Investors have not panicked. Markets are still open. Yet for the first time, you understand that none of the variables determining your future are actually under your control. Central banks begin making decisions that affect trillions of dollars overnight. Regulators introduce emergency measures. Banks tighten lending standards. Institutional investors start reducing risk regardless of price. Each action is rational from an individual perspective. Collectively, they create forces far larger than any single participant can influence. You try to adjust. Positions are reduced, new capital is raised, exposure is lowered, but every action now happens under pressure. Assets that could have been sold easily a year ago now require significant discounts. Buyers become selective. Liquidity disappears precisely when it is needed most. The problem is scale. When you managed hundreds of millions, changing direction was relatively simple. At tens of billions, every adjustment becomes a major operation. Markets notice your movements, competitors analyze them, media speculates about them. The larger your organization became, the less flexible it became. Investors who once praised your confidence begin questioning your judgment. Some withdraw capital, others demand explanations. Every redemption request forces additional sales. Every sale places more pressure on the portfolio. The cycle begins feeding itself. At the same time, information becomes less reliable. Analysts disagree. Economists publish conflicting forecasts. Market signals contradict one another. For years, you believed that more data would lead to better decisions. Now you discover that during periods of instability, more data often creates more uncertainty. This is the moment the illusion finally disappears. For more than a decade, you believed you were controlling Wall Street. In reality, you were benefiting from conditions that made control appear possible. The market was rising, liquidity was abundant, confidence was strong, the system rewarded expansion. Now those conditions are gone. And for the first time since entering Wall Street, you realize that the system has always been larger than you. The collapse is not a single event. There is no moment where a bell rings and everyone suddenly realizes the game is over. Instead, the system begins failing piece by piece. One institution reports losses, another announces layoffs, a major fund suspends withdrawals, credit markets freeze further, confidence continues disappearing faster than anyone expected. Your fund loses billions within months, not because every investment was wrong, but because the system itself is contracting. Investors demand liquidity, assets are sold, prices fall, falling prices trigger additional redemptions. The cycle repeats. Positions that looked safe under normal conditions become dangerous under stressed conditions. Models built on historical data fail because historical conditions no longer apply. The financial consequences are severe. Assets under management shrink dramatically, revenue falls, expansion plans are cancelled, entire departments are eliminated. People who worked with you for years lose their jobs. Analysts, traders, support staff, and executives all become casualties of decisions made long before the crisis became visible. The social consequences are equally significant. Relationships that were built around success begin disappearing. Some investors stop returning calls. Media outlets that once praised your strategy now publish articles explaining your mistakes. Competitors quietly distance themselves. Wall Street respects performance. When performance disappears, respect often disappears with it. The psychological consequences are harder to measure. For years, your identity became connected to growth, influence, and control. Now those foundations are gone. Every headline reminds you of losses. Every report highlights what should have been done differently. The same decisions that once looked intelligent now appear obvious mistakes in hindsight. The most painful realization is that the collapse was not caused by one bad trade. It was caused by a chain of incentives that encouraged risk during good times and punished that risk during bad times. The system rewarded expansion when conditions were favorable. The system punished scale when conditions changed. By the end, the numbers tell the story clearly. Tens of billions have disappeared. Years of growth have been erased. The organization survives, but it is no longer the empire it once was. And for the first time since you entered Wall Street, nobody is asking how much bigger you can become. They are asking whether you will survive at all. 5 years later, the crisis is no longer the main story. Most people have moved on. Markets recovered. New funds replaced old ones. New executives took positions once occupied by people who were considered untouchable. Wall Street continues operating exactly as it always has. The names change, the structure remains. Your organization still exists, but on a much smaller scale. Assets under management are a fraction of what they once were. The private jets are gone, the endless expansion plans are gone, the media attention is gone. Surprisingly, the disappearance of those things changes less than you expected. For the first time in years, you are able to examine the system without being fully consumed by it. The conclusion is uncomfortable. Wall Street was never truly about predicting markets. It was about managing incentives. Every participant responded rationally to the environment around them. Investors chased returns because they were expected to. Funds increased risk because competitors were doing the same. Banks expanded lending because demand existed. Regulators reacted after problems became visible. Nobody needed to act maliciously for instability to emerge. The structure itself created the outcome. The biggest mistake was not leverage. It was not a specific investment. It was not a single decision made during a stressful meeting. The biggest mistake was confusing influence with control. As your assets grew, your influence increased. You could move markets. You could influence corporate decisions. You could attract capital from around the world. Eventually, you started believing that influence meant control, but influence only exists while the system allows it. Control suggests independence from the system, that independence never existed. Wall Street rewards confidence during expansion and punishes confidence during contraction. The same traits that help people reach the top often become liabilities when conditions change. The system is designed to amplify both success and failure. Looking back, the lesson is simple. Nobody controls Wall Street. Not hedge funds, not banks, not billionaires, not governments. Every participant operates inside a network of incentives, liquidity, confidence, and risk that is larger than any individual institution. For years, you believed you controlled the market. In the end, you discovered that the market was controlling everyone.